Singles are at a huge tax disadvantage in retirement. So in this video, I want to discuss why that's the case and give you 3 tips on how to navigate this through retirement to make sure you're paying as little tax as possible and put as much money back in your pocket. The main reason single people pay more tax in retirement comes down to income splitting and the ability to split your income if you have a spouse or common law partner. Now, what does income splitting mean? Let me break this down. Income splitting is the ability to transfer or give some of your income to your partner. And I don't mean actually give money to your partner. I mean on paper when you file your taxes to give them that income. So let's say you had $50,000 of income. If you're only one person, all of that $50,000 is taxed in your hands. Now we have a personal exemption of $15,000, meaning that the first $15,000 that you make is tax-free. Anything above that, in this case $35,000, is taxed. Now, if you're 2 people, you can take that $50,000, we can split it into 2, so $25,000 each, and you each have that $15,000 personal exemption. So there's $30,000 of tax-free income versus 15. That's a big part of it, but that ability is there because of that income splitting. So let's look at the software and I'll show you kind of what this looks like and how we can navigate it going forward. So I first want to look at a couple here that's earning $42,000 after tax. And you'll see the real income, $42,000 adjusted to inflation, and the total tax bill. So you can see the total tax bill in year 1 is $447. Now, if I go into both Mr. and Mrs. YouTube, you'll see that Mr. YouTube has the income splitting. So pension splitting right here, that's income splitting, $7,600, meaning that on paper, he's transferring that much money over to Mrs. YouTube to lower the tax bill, to level out that tax bill. Now, when I talk about leveling the tax bill, it's based on the fact that we are in a progressive tax system here in Canada, meaning that, as I mentioned earlier, the first $15,000 is tax-free, but after that, it's actually scaled. So you can see here, this is it based on BC, combined federal and provincial tax rates. The first $47,000 is taxed at 20% on other income. Then it jumps to 22, then 28, then 31. And this progressive tax rate, the numbers are a little bit different based on which province or territory you're in, but the concept's the same. The more money you make, the higher your marginal tax rate is, how much tax you pay on the next dollar that you earn. So the more you make, the more tax you have. So if you have someone sitting in the chair beside you that you can shuffle some of that income to and some of that tax bill to, it puts both of you in that lower tax bracket. So again, not only are you getting that personal exemption, but you're paying that next dollar of income at a lower tax rate. So if we go over to Mrs. YouTube, you'll see the same pension income splitting, but it's a positive number, $7,600 positive, because she's taking on that income for tax purposes. And you can see, even though she's taking on $7,600 in this scenario, she's still paying 0 tax. Next year, 2025, she's paying $64 of tax. So even with that shift of income, she's paying little to no tax. Most of the tax in this scenario is on Mr. YouTube's side. And again, it's very little at $447. So when we look at that combined tax, so this is for a couple earning $42,000 after tax, the total tax bill is only $447. Now, let's take a look at a single person earning the same amount of income and how much tax they would have to pay. Now here we have Mr. YouTube who does not have a Mrs. YouTube, meaning that all of this income is going to be taxed in his hands. So this is the disadvantage of retiring as a single, is you can't split that income with anyone else. So $42,000, you'll see he has a total tax bill of $1,972, substantially more, because he was unable to transfer some of that money over to his spouse or common law partner to reduce that tax bill. So about $1,500 more of tax just in the first year. So again, this is a compounding issue that leaves the estate with less money. There's less income obviously ongoing. The more taxes you pay, the less income you have in your pocket. So because singles can't income split, they're obviously at a huge disadvantage, which I just showed you here. And there's really no way around that. You cannot kind of make up this person to income split with. But I'll give you some tips here in a second that will help you navigate this as best as possible. One thing to remember though is For single people, you typically need about 70 to 80% of what a couple needs in retirement. So you're paying more tax, but typically your income requirement is also a little bit lower. So that helps offset the total tax payable. Obviously, you have less money in your pocket, but if you need less because there's only one person, it does offset it a little bit. So that's something to keep in mind. It's not a true apple-to-apple comparison. So do remember, if a couple needs $42,000, maybe as a single person you need $35,000, $36,000. So your tax bill is not $1,900, maybe it's closer to about $1,300 or $1,400. As many of you know, about half of you entering retirement are entering it single, without the person to be able to income split and save taxes. So what are a few strategies that you can employ in your retirement plan to help you navigate this better? So I want to give you 3 tips. And tip number 1 is around CPP and old age security timing. So obviously as a single person, you only have one Canadian pension plan and you only have one old age security. So right there, you're at a disadvantage. You only have 2 of these government pensions, things that you've paid into and that you're going to earn back, not 4, like a lot of couples. So that's something to keep in mind. So it's really important to sit down with your financial planner and map out when is the best time to take your CPP, to take your old age security, because the impact it has on your plan is hugely beneficial, or can be hugely beneficial if you do it right. And so when you have a couple, if one of you took it at 60, the other person can realize, oh shoot, we maybe screwed this up. Let's do the other one at 70, kind of buffer it a little bit. There's a bit more flexibility there. But for you as a single, your decision is your decision and it impacts you for the rest of your retirement. So make sure you understand the timing and the impact it has on you and your cash flow in retirement. So if I go back to the scenario here and show this same single person at age 65 retiring, I have this mapped out until age 90. And so you can see the most amount of money based on the assets that they have in here, and I won't change the asset mix here, but is $43,264. So if we said, look, based on how much money they have, CPP old age security, they could draw out $43,264. And this is based on taking CPP and old age security at age 65. So I want to show you an example, just a basic example here of what happens if this person delayed CPP till 70. Would it help them in their overall cash flow? So jumping in here, we've changed nothing other than you can see the CPP now starts at 70 versus 65. And you can also see that the income after tax adjusted to inflation is $44,400. So over $1,000 more per year after tax in their pocket adjusted to inflation. So as you can see there, just by delaying CPP, they've added an extra $1,000 every single year after tax in their pocket. Now, there's some other benefits that I'll get to here in a minute, but you need to look at CPP and old age security timing. You want to put the most after-tax money in your pocket, and often delaying these benefits can give you more money. So make sure you sit down with your financial planner and run these numbers for yourself. The second tip I have for you as a single going into retirement, how do you make sure you pay as little tax as possible? Put the most money back in your pocket, protect your cash flow, and put yourself in the best situation. Like, there's so many pieces to this that you have to look at. And delaying CPP, maybe delaying old age security, puts more money back in your pocket. But there's another layer to this that will create better structure and give you more money. And that's what we call the RRSP meltdown. And what the RRSP meltdown is basically drawing out of your RSP or your RIF account a little bit quicker than you typically would otherwise. A lot of you just take the minimum amount and you put yourself in a bad cash flow and estate situation. In this situation here, we've melted down the RSP, or the RIF in this case, from age 65 to 70. So as they've delayed Canadian pension plan, we've drawn more out of the RSP. And a lot of you say, yeah, but Adam, now I'm spending my own money down. I'm a single person. I'm losing control of that. But what we're doing is we're reducing the tax bill. You'll see the total income is $44,590. So we're actually having more after-tax money. So a lot of you think, well, I'm spending my money down, I'm going to have less money. It's not ideal. But the reality is we actually have more money after tax in our pocket every year from age 65 to 90. And so that's by creating some tax efficiency around the RSP. So drawing down that RSP by $40,000 a year. Once CPP starts, you'll see it bumps to $24,000. And the RSP, or the RIF account, is drawn out by life expectancy, about age 86. Now, a side benefit of the RSP meltdown, not only does it give you more after-tax money in your pocket, but you can see the tax-free savings account stays intact. You're not really spending. There's very minimal amount coming out of that account every year, meaning that as you get on with age into your 70s and 80s, you have over $100,000 sitting there that you can get tax-free at any time. Whereas if you're dipping into your TFSA earlier on, you're going to have to pull from your RSP as taxable income if you have that emergency later. So if we look at an age, let's say age 85, you'll see the RSP is almost melted out, but the TFSA account still has over $130,000 in it, meaning that if you had an emergency, if you needed $10,000, $15,000, $30,000 to pull out, maybe you need to go to a care home and you need to make a deposit on that. There's flexibility in there. Whereas if we don't have the RSP meltdown, it doesn't look quite as good. And so going back to the other scenario where we delayed CPP, but we didn't do the RSP meltdown, you can see here, that tax-free savings account is depleted by age 71. And so any additional income that you're gonna need beyond your regular income draw, it's coming from CPP, your old age security, and your RIF account. So if you do have that emergency, you're pulling money from your RIF account, you're driving up your taxable income, it's not a great situation to be in. And at the end of the day, you have less in your pocket for income based on this scenario. So let's recap the first two. The first one is you need to look at your CPP and old age security timing. Again, the perfect time to take it for you might be different than your neighbor, your coworker, whoever else you have in your circle around you. You need to run your numbers in your situation. The second layer to that is then, if I delay my CPP and maybe my old age security, what does the RSP meltdown look like? How much should I be taking out? How do I make sure I protect my TFSA for later in life? That's really important. You don't want to deplete that TFSA early on in retirement because you've delayed your CPP. Spend down your money. I know it sounds weird to say, look, spend your money and don't spend CPP. We all want to take the free government money, but the reality is it gives us less in our pocket. You have to look at the after-tax income in your pocket. It kind of goes against the grain on that, but again, if you run it again and again, we've done thousands of plans in our office, and I can say again and again, this strategy works. It works well. We've done it for thousands of Canadians, and those that have implemented it are reaping the rewards of more income in their pocket after tax. The third and final tip is you need to look after yourself, and there's a few layers to this I want to cover. The first layer is flexibility. And you saw there with that tax-free savings account is you have that flexibility later in retirement. Having the TFSA, not burning it down early in retirement by delaying your CPP, drawing down your RIF account a bit quicker in that RSP meltdown, it gives you that flexibility with the tax-free savings account. That's looking after yourself. If you have that emergency, which will happen in retirement, you can draw money from there on a tax-free basis. Hugely beneficial, hugely important as you put your financial and retirement plan together. The second benefit of drawing down your RIF account in a tax-efficient manner is your estate actually has less tax due. As I showed you, the RIF in that second scenario was drawn out by age 86, meaning that if you passed away at life expectancy, you only have your TFSA account left, meaning that it's all tax-free income. Whereas if you draw down your TFSA, left your RSP a little bit longer, your estate actually has a lot more tax on it. So it's not as good of a tax situation. But a lot of you are saying, yeah, but Adam, spending down my own money versus doing the CPP, that's not going to work out better. So let's actually jump into the software to look at that. So here's a scenario where we're taking CPP at age 65. We're not drawing down the RSP. This is the retirement that the majority of you will live through if you don't have a proper plan. And I want to show you this, estate before tax, but what's your estate after tax? So you can see here, if I click on here, you'll see in the top left, estate after tax in nominal dollars, $116,521. So keep that in mind, $116,521. If we go to the scenario where we've delayed CPP till 70, we've done the RSP meltdown, let's take a look at age 86, which again is life expectancy for a Canadian here in Canada, based on an age 65. So again, we're using real numbers here. And you can see it's $117,788. So more money based on delaying CPP and the RSP meltdown. So for a lot of you that may say, well, okay, that actually makes sense now. So hopefully that sells you on this strategy and that it helps you both today and in the future. Now, the other part about taking care of yourself is all about making sure you have consistent, solid cash flow later in life. And so when we look at the scenario of delaying your CPP, you will have a lot more guaranteed CPP income. We all want that defined benefit pension plan, but most of us don't have it anymore. But the reality is we all have it in the form of our old age security and Canadian pension plan. Now, old age security, that is something based on how many years you lived in Canada. It's nothing that we paid into. So could the government take it away down the road? Yeah, potentially they could. So let's focus on the Canadian pension plan. That's something that we paid into. It's a benefit to us. There's just some research done on it that it's funded for beyond 75 years, and I'll do a video on that here coming up. But it's in a great spot and it's going to be there for you through retirement. So why don't we use that as our defined benefit pension plan and try to maximize that to make sure we have the most amount of income out of it, both today and in the future, as possible? So if we take a look at the scenario where we delayed CPP till 70, let's grab age 80 as an example. So you'll see at age 80, the total CPP payment for this person is $26,805. So that's how much they're going to collect off their CPP because they've delayed it. Again, a large number at age 80. If we go back and look at the scenario where they took CPP at 65, they've had less income, and that guaranteed defined benefit plan at age 80, you'll see here, is only $17,787. So a substantial difference in guaranteed inflation-adjusted income later in life. Again, how do you create a bigger defined benefit pension plan? You delay your CPP. It's a great strategy, and especially for you singles. So again, let's recap all three. It's CPP and OAS timing. It's a proper RSP meltdown strategy to avoid that tax bill, to create structure around your TFSA account, to put the most money back in your pocket after taxes. And thirdly, you want to look after yourself. You need to look at what's that guaranteed income later on by delaying that CPP. How do I make sure I have some buffer with that TFSA account? How do I make sure I structure my life so later on in life, when it's still just me maybe, that I'm looking after myself? All of these strategies come together to encompass a great retirement plan. So yes, income splitting is not available to singles. And will it ever be? Maybe. There could be some rules that come in that help us out. But at the end of the day, singles are at a disadvantage, but there's a few strategies which I've talked about here that will help you navigate this as best as possible. Sit down with your financial planner, run some of these scenarios with your data, with your plan. If you need help with that, reach out to our office. We'd be happy to help. You can learn more about our planning at parallelwealth.com/planning. We help Canadians with retirement planning from coast to coast. We'll see you in the next video.